There are 4 different categories of assets that you can consider converting your money to. That way now not only can you protect your money against high inflation, but you can also benefit from inflation. Number 1 is by investing your money into your own income. Number 2 is by investing your money into passive assets. Number 3 is by investing your money into more of active assets. And number 4 is by investing your money into more of protectionary assets. Let me start by talking about investing your money into your income. Your income and your expenses will ultimately determine how much money you have left over to be able to invest in other assets. And for this particular income topic, I'm not talking about the income you get from your own business, but if you're working a job, meaning you're working inside of somebody else's asset. Because if you're an employee in a business, well, somebody owns that business, that's an asset for them, but you are a piece of that business. Now, the first thing you want to do is you want to make sure that you are a valuable part of the business. You want to make sure if you are an employee that you're able to succeed and do well as an employee, because if you do well as an employee, you're going to be the one that can get the most raises, the most promotions, the most bonuses. You want to make sure that obviously you are working somewhere where you have the ability to succeed and see more of that upside. So you want to be working to invest in your income. How can you increase your income? Now, this might be you going out and getting a certificate if you're not happy in the career that you're in. This might be you working to get a promotion or to get a raise. This might be you working a second job that we can earn more income. Or this might be you working more on a commission basis, where now you have the ability to earn more money if you put in more work, something like a sales position, because now you're working not to go out and buy a car. This is the mistake that the majority of Americans make, is that they work to buy things, and then they work harder to get a raise, that way they can buy even nicer things. When the majority of Americans go out and get a raise, they have to show it off with a new car, or they have to show it off with a vacation, or they have to show it off with a bigger home. That is a guaranteed route to being broke. So what you need to do now is, number 1, invest in your own income, work to earn more money. And the reason why you want to work to earn more money is so you can have more assets. The reason why you have more assets is because your assets are what will actually make you wealthy. Your savings are not there to make you wealthy. Your savings are there to protect you against an emergency, or you can use your savings to go out and buy investments, buy assets at a discounted price, or just buy assets in general. You're saving money to buy assets, or you're saving money to protect you. You should not be saving your money to become wealthy. That's not what your savings are there for. So now, when you're working to earn more money, what's the reason why you're working to earn more money? It's so you can buy more assets. Because now if you can buy more assets, you can buy more investments, you can create more cash flow, or you can have more wealth, which will then be able to fund more of your lifestyle. So if you want to have a bigger lifestyle, great. I want you to have the nice things. But you want to make sure you can do it the right way. Most people make money to buy nice things and then wonder why they're always broke. Wealthy people make money to buy assets and then let their assets pay for the nice things, and then they never have to worry about money because they own the assets which continue to produce an income for them even when they're not working. The second type of asset that you want to own to protect you against inflation are passive assets. Now, the thing that I want you to understand here is that inflation can be a double-edged sword, because on one hand, when you have low to moderate amounts of inflation, that causes the price of assets, things like stocks and real estate, to grow because, well, when you have inflation, that means people have to pay more money for rent. That means people have to pay more money for their groceries. They have to pay more money for their things, which means that these businesses and the landlords make more money. So on one hand, and the low and moderate inflation, that benefits the asset owner. But then when you have too much inflation, that comes back around to bite you, because then if you have too much inflation, that means that people no longer have the ability to spend because they have to pay so much money for their rent. They have to pay so much money for their groceries and their gas and their travel, that now they have limited leftover money. And when people have limited leftover money, that can then contribute to an economic slowdown or a recession, which then hurts asset prices. So you have to understand that inflation in general is good for assets, things like stocks and things like real estate. But when you have too much inflation, that can come back around to then hurt those same assets. But understand that in general, inflation is good for these assets. So I want you to understand that, and nothing works in a vacuum. Nothing goes up or down linearly just based off of one other factor. There are so many factors that impact the prices of things. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will probably lose money, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Now, the two main types of passive assets that I want to go over are stocks and real estate. Stocks are much more accessible for people. Real estate is less accessible. It takes more money, it takes more time, it takes more capital. It's fair. That's just the way that it is. Now, you can do one or the other, regardless of where you are. You just have to set your mind to whatever it is that you want to do. So I want to start by talking about stocks as a passive investor, and then I'm going to talk about real estate. Now, when I say passive investor, the reason why I'm saying it this way is because this is not something that you really are building yourself. Now, of course, if you are a real estate investor, you can be actively involved as a real estate investor, but it's still considered a passive investment. Even in the stock market, you could be a full-time stock market investor, but you're not the CEO of the companies that you're managing. You're managing your investments. You're not managing the operations. And so when I talk about being a passive investor, I'm talking just broadly stocks and real estate. I know that I talk about being an active investor in real estate and stocks, and I talk about how I'm an active investor in real estate and stocks, but that's not what I'm talking about here. When I talk about being an active investor in this video, I'm talking about managing the actual operations of that entity. And for this purpose, I'm going to be talking about your own business. But when I talk about passive assets today, I'm talking about stocks and real estate on a broad level. Now, there are a lot of different ways you can invest in stocks. For the purposes of this video, I'm going to be focusing on more of the passive side, investing in funds, because when you invest in the stock market, most people think that the way that you win is by finding the next Amazon, or by finding the next Google, or by finding the next Apple. But very, 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 very few people are going to be able to do that. Very few people are going to have the psychology to be able to hold on to an investment in the early stage through all the downturns and continue to hold on to it and make investments into it. Very few people are going to have the financial IQ to want to research these companies, and very few people are going to want to go through that type of roller coaster. Investing in individual companies is difficult. It takes work. It takes research. And it does take a little bit of luck too. But the alternative for 90 to 95, maybe even 98% of people is to invest in funds, which are now a group of companies. Because the reality is most people lose money in the stock market. But if you look historically, the stock market has gone up by 7 to 10% a year on average over the last century. Now, that doesn't mean the stock market always goes up, but historically, over the long term, the stock market has gone up pretty consistently. Yet we keep hearing about people who hate the stock market because they keep losing money in the market against these big players. Why does that happen? Because people are trying to find the next big thing. They become traders, or they just don't know how to manage the psychology of their investments. If you want to win in the stock market, the simplest way to do that, not the easiest, but the simplest way to do that is to invest in low-cost funds, whether it's an ETF or index fund, that give you broad exposure to the economy or to the stock market. Keep investing your money into it every week, every 2 weeks, or every month, and you do this for a long time. And when I say long time, I don't mean 6 months. I mean years or decades. If you do that now, you're essentially just buying a piece of the American economy. And when you're buying a piece of the American economy, well, if the economy continues to grow, your investments will continue to grow. So this is where now just understanding the different ways that you can invest your money into these types of passive investments. That way you can get exposure to this types of wealth. Now, I'm going to go over a few different types of ETFs that you can consider investing your money in. I'm not recommending any of these. Do your own research before you make any investment. I am not a licensed financial advisor. I'm just a random guy on YouTube. So do your research before you start investing into anything. But let me go over a few different examples. A few examples of ETFs that you can consider investing in are VTI, SPY, DIA, and SCHD. And as a little disclaimer, I personally am invested in SCHD. VTI is an ETF that gives you exposure to the total stock market. What does that mean? Instead of you going out and investing in every stock on the US stock market, all the major stocks, now you can invest in this one ticker symbol, VTI, and you're going to get broad exposure to the general stock market. Now, you don't have to go out and invest in all these companies and keep up with every single company. You invest in that one ticker symbol, and now you're getting exposure to essentially the United States economy. SPY gives you exposure to the S&P 500. The S&P 500 is one of the longest tracked indexes. It is the 500 largest companies on the stock market. So now, if you said, I don't want to invest in everything, I just want to invest in the big companies, well, SPY is one ETF that will give you exposure to the 500 biggest companies on the stock market. Now you're investing in the big companies that make America America, and you don't have to keep up with all 500 of these companies. You just put your money into the fund, and now you're getting exposure to the big companies in America. DIA gives you exposure to the Dow Jones Industrial Average. The Dow Jones Industrial Average is, again, a very popular index, meaning group of companies. This is made up of 30 different companies on the stock market, some of the biggest and most well-known companies on the stock market in different indexes. Now, again, the Dow Jones is one of the most tracked and most talked about indexes, and instead of you going out and investing in each individual company, you can invest in this one ETF and get exposure to the Dow Jones and now own a piece of the Dow Jones. SCHD is a dividend-paying ETF, meaning this is an ETF that people invest in for the sole purpose of investing in high dividend-paying companies. What are dividends? Dividends are cash flow. This is when a company will pay you every 3 months for doing nothing except owning that stock. So now when you go out and invest in something like SCHD, now again, you're working to create that income. You're working to create that cash flow. Now, when you go out and you hear an ETF or a stock is paying out a 4% dividend, that might not seem like a lot of money. Because if you invest $100, that's only $4 of cash flow that you're going to get over the course of a year. If you invested $100,000, you're only going to get $4,000 worth of cash flow. If you invested $1 million, you're getting $40,000 a year of cash flow. And that discourages a lot of people. But the way that you win in this cash flow game through your investments is not by making a one-time investment. It's by investing a little bit of money every time you get paid, whether it's every week, every 2 weeks, or every month. I personally love investing for cash flow, and the way that it works for me in the stock market is I'm investing every week into my dividend-paying ETFs. Every week, I'm throwing more money into these ETFs, into these assets, and then every 3 months, they're throwing more money at me. Now, every quarter when I get my dividend payout, the amount of dividends that I'm getting is growing because, for one, I'm investing more money into these dividends. Like every week, I'm putting more money in there. But then number two, every time I get paid with my dividends, I'm taking this cash flow that I'm getting and I'm using it to buy more of these assets. So I'm just working to continue growing the amount of cash flow that I can get because I just want to own more of the assets. So now, what am I doing in this game? I'm working to just build and stack up the cash flow. This is one way that you can start investing your money in a passive way that you can get exposure to the United States economy without having to go out and research individual companies, without taking on all the risk, without spending all the time, without having to learn about how to analyze companies. It's a simple way for you to start doing this. And there are brokerages out there, stock brokerages out there that specialize in this type of passive investing. I've talked about M1 Finance. They have been a sponsor for me in the past. They're not currently a sponsor for me, but I am an affiliate with M1 Finance, meaning if you use my link, I will get compensated. I have a link for M1 Finance down in the description. I like them. I use them because it's so simple to use. They make this process super easy to invest into stocks passively. Again, you can find the right brokerage for you. That's just who I like. Do your own research. And if you use my link, I will get paid. All right? Simple as that. The next way that you can invest passively is real estate. And the reason why I like real estate so much is a couple reasons. Number one, I can create cash flow. Number two, you get tax breaks when you invest in real estate. But then number three, more particularly for the topic of this video, you own a hard asset. Because when you invest in real estate, you own something that you can see, feel, and touch, which creates a lot more power and a lot more opportunity, especially if you're worried about the health of the United States dollar. Owning real estate gives you something real, gives you something tangible. And if we just talked about the worst case scenario, let's just say the dollars went down the drain. People stopped caring about the value of the dollar. Well, if you own real estate and your tenants have to pay you rent and you don't want dollars, you can have them pay you in chicken eggs or duck eggs or whatever it is that you want because you own the asset and now you can get paid however it is that you want. Now, going back to the topic of real estate, the way that it works is you're going to go out and buy a property, whether it's a condo, whether it's a single family home, whether it's an apartment complex, whether it's a duplex, whether it's an office building, whether it's a retail building, whether it's a mobile home park, whether it's a storage facility, whether it's something else, a mixed use building or anything. Your goal is to buy this property, not so you can flip it. That's what flippers do. When I'm talking about investing, it's not flipping. I'm talking about accumulating assets, owning real estate, playing the game of Monopoly. That way now you can collect rent. Every first of the month, you get a new rent check comes in. And if you do it correctly, this rent check should cover all of your expenses, your property taxes, your insurance, your maintenance fees, your management fees, your vacancy fees, and everything in between. And then put some money in your pocket even after paying your mortgage payment. That is the right way to do real estate. That's the way that I invest in real estate. Now, when you do it this way and you do it correctly, not only do you create cash flow that can be passive. It's not completely passive, but it can be generally passive if you have a good management team. But now you also can get access to a lot of tax breaks, because as an attorney who's not your attorney, I can tell you that real estate has some of the best tax breaks that our tax code has to offer. These tax breaks can allow you to earn money and pay little to no money in taxes every month legally. And it can also allow you to make a lot of money on your real estate gains, meaning you buy a property for $100,000, sell it for $200,000, and pay no money on that profit today if you use that $200,000 that you just got from the sale of your property to go out and buy a bigger property. This is called a 1031 exchange. There's a lot of tax breaks that the real estate tax code offers. And that's why wealthy people love investing in real estate. So there's a lot of benefits to being a real estate investor. And when I say being a real estate investor, that does not mean going out and buying a big home for yourself to live in. This means you going out and buying real estate for other people to live in. And yes, it is difficult. Yes, it takes more money. But if you dedicate yourself, you say that you want to be a real estate investor, I can guarantee that no matter where you are financially, if you dedicate yourself to being a real estate investor, a number of years from now, you will be able to go out and buy your first rental property. If you dedicate yourself to it, you start learning about it, you start learning about creative financing, you start putting money aside for it. If you put in the work, 5 years from now, you will find a way or a solution or a path to being able to start investing in real estate and at least making your first real estate deal, but you have to get committed to that. I'm going to jump back into the video in just 1 second, but before we do, if you want to learn and build on top of your financial education, we have a free ebook in my Market Insiders company, which goes over how you can start investing your money, how you can start generating cash flow, and how you can start putting your money to work even if you don't have a lot of money to invest. This ebook is completely free, and it'll walk you through different investment strategies, how you can start investing, how you can start investing in stocks, how you can start investing in real estate, and how you can start getting cash flow on the money that you invest. So if you want to learn more about how to start investing and you want to build on top of your financial education, this is a completely free guide that you can read and access. So if you want to read the guide from Market Insiders, I got the link to how you can download this ebook for free down in the description below. The third way that you can invest your money to protect against inflation is to invest into an active asset. And in this particular instance, when I talk about an active asset, I'm not talking about investing in stocks or real estate actively. I'm talking about investing into your own business. Because when you invest in your own business, what are you doing? You're investing into the infrastructure that allows you to create an income. You're investing into the ability to create and build a money printing machine. Now again, worst case scenario, what happens if dollars go to nothing? Well, now you can change what you charge for your products or for your business. And so now when you're investing in your own business, you are building an inflation hedge. Now, again, when you have a business, in general, inflation is good for you, because now when inflation happens, you can raise the price of your products to compensate for inflation. If the prices of things, if inflation goes up by 2%, if inflation is 2%, and you have to raise the price of your products 2%, well, your cost will also rise by 2%, which means if you sell something for $100, your cost is $50. Your cost went up by 2%. That means it went from $50 to $51. And now you are selling your product for, instead of $100, $102. That means you increased your costs and your sales price by 2%. Well, now you pay more money. You're paying $51, but you're generating $102, which means you're effectively making a little bit more money as well. This is where now there's a lot of benefit to being a business owner. Now, again, not everybody's meant to be a business owner. Not everybody can be a business owner. Not everybody should be an entrepreneur. Let me actually rephrase that. Everybody should be a business owner if you are in America. If you are in America, in this capitalist system, you need to be a business owner, period. But that doesn't mean you need to operate a business or run a business. In fact, most people should not. You can be a business owner by investing in stocks. That makes you a business owner. But you should not be in the business of operating a business. Some people should. Being an entrepreneur is difficult. And if you want to be an entrepreneur, that can be another way for you to invest your money into your own business idea, into your own brand idea, to build an infrastructure. Now, this could be a intellectual infrastructure into the value of your business and what you do to sell products, or this could also be physical infrastructure, machinery, real estate, other places that will allow you to continue to run your operations. So when you invest in your own business, again, you're building this asset that will allow you to protect yourself against inflation and whatever else is going on in the economy. And the fourth type of asset that I think a lot of people worry about when you hear about concerns with the United States dollar are, what are the protectionary assets out there that will allow me to protect and preserve my wealth no matter what's going on out there? Now, the first one is one that I've already talked about, which is real estate. Real estate can be a great protectionary asset because, again, it's something that you can see, feel, and touch that provides a real tangible value. If you own land, you own this building, it can provide shelter to somebody and it can produce an income for you. So that real estate can be a great protectionary asset because, number one, it's tangible. Number two, it provides a very visible value. And number three, it can produce cash flow with that as well. The second one, which is growing in popularity, would be something like physical gold. Now, I own physical gold. It's not a huge piece of my portfolio. My physical gold is about 2% of my entire investment portfolio, and it doesn't really do much. My physical gold just sits there, just looks back at me. It doesn't generate an income like my real estate does. It doesn't do anything. It's just a hedge. I look at gold like insurance, doomsday insurance against the worst case scenario. For me, in fact, I don't even really pay attention to the prices of gold. I don't keep up with that. What I do is I look at gold as an alternative way for me to save money. Every month, I have a passive system set up where every month I have some cash that leaves my checking account and it's automatically going out to buy me some physical gold. Period. It's just an alternative way for me to save what I call hard money. And the reason why I personally invest in gold is because my theory is if I took $50,000 of cash today, and then I took $50,000 worth of physical gold, and I dug both of these in my backyard today, and I buried it. And then 10 years from now, I go to dig these up. I dig up the $50,000 worth of cash. I dig up the $50,000 worth of gold. I believe, my theory is 10 years from now, my gold will have more buying power than my cash. Could I be wrong? Absolutely, but this is my theory. And that's why I also have gold as an alternative way for me to save money. Now, some people also use silver. You can do your own research on silver. Some people like silver because silver is used in a lot of applications in the world. It's used in a lot of businesses. I just buy gold because, one, gold has been like that currency since the beginning of time. Everybody has valued physical gold. So for me, it's a simple way for me to get exposure to that. The third way for you to own and invest in protectionary assets is, again, now going to be through the stock market, this time through investing in countries and currencies that are not the United States dollar. Because in the United States stock market, in our stock market, you can get exposure to countries and currencies overseas. There are ETFs that will allow you to do this, that will allow you to invest in international countries, that will allow you to invest in emerging markets. I'll give you a couple examples. Again, I'm not telling you what to invest in, do your own research, but a couple examples are VXUS and VWO. And as a disclaimer, I personally invest in VWO. These are two different ETFs now that will give you exposure to countries and currencies outside of the United States, outside of the United States dollar. So now what are you doing? You're taking a risk. So these are higher risk ETFs, higher potential upside, higher potential downside. But now the whole idea is if something bad were to happen to the dollar, these are a little bit more protected because, well, these entities are a little bit shielded from the dollar. These are countries that, yeah, maybe they'll be impacted if the dollar gets hurt. They'll be impacted if the United States economy gets hurt, but they don't rely and revolve their currencies and their economies around the United States dollar. So now, when you create your investment portfolio, you can find different types of ETFs to invest in. Like what I do is I have 4 different general categories of ETFs that I invest my money in. Again, don't copy me. Do what's best for you. I don't recommend what I do to anybody. The first thing that I invest in, and the largest thing that I invest in, are dividend-paying ETFs. Why? Because I like cash flow. Number 2 are value ETFs. Why? Because, well, it's a kind of your more stable and safe, considered safe investment, and it also pays cash flow. Number 3 are the innovation ETFs, more risk, more potential return. I like investing in innovation. For me, it's fun. And number 4 are my international ETFs for this very reason. These are my protectionary ETFs. These are countries and currencies overseas that give me exposure to things like emerging markets, to other international countries. That way now I can invest in the businesses and the countries that are not reliant on the United States dollar. So it's an alternative way for you to get exposure and protection against the dollar. And then this brings me to the last protectionary asset, which would be cryptocurrency. Now, again, I don't recommend this to anybody. Cryptocurrency is highly volatile, highly risky. I invest in cryptocurrency. The reason why I invest in cryptocurrency is because I believe in the value of the blockchain. I think there's a ton of power, a ton of use cases for cryptocurrency. But I think a lot of people who get involved with cryptocurrency think of it as a get-rich-quick scheme, and they use it for things that cryptocurrency is not necessarily intended for. So I like cryptocurrency because I've used it before. I have people that work for me in countries that's far away. And now if I want to send them money, previously what I'd have to do was I'd have to go to the bank and send them wires. This used to be a very painful process. And yes, the bank that I used to bank with didn't allow me to send wires to my phone. So it was a big pain. I had to go to the bank physically and send wires. Well, I also began traveling a lot. And now when I would get payment requests and I was traveling, and if my bank wasn't near me, it was a big stressor for me because I hate when people are relying on me to pay them. When I get a bill, I want to pay it as fast as possible. I hate bills sitting over my head. It's just a pet peeve for me that it just really stresses me out. So now I was in California at the time. Actually, I'm in California right now too. But I was in California at the time, and there was no bank nearby me. And it created a lot of stress for me because now I had to figure out I had to go pretty far to go out and find this bank, to go in there, make this wire, and then pay my contractor. Well, then after a bunch of times of this happening, he said, hey, would you mind just paying me in cryptocurrency? Because his country didn't allow PayPal. It didn't allow Payoneer. It didn't allow a lot of different platforms. And I said, yeah, I got crypto. He said, would you mind paying me in crypto? So I went on to my brokerage. I sent him some crypto. In less than a minute, not only did he receive the money, but the fees were a tiny fraction of what I was paying before. And that was when I realized, okay, there's some real value here with cryptocurrency because it can change the way that we do payments. They can change a lot of different things. So I like cryptocurrency for that reason. Am I advocating for you to buy crypto? Absolutely not. But you also have to understand how cryptocurrency plays a part in my portfolio. 10% or 20%, less than 20% of my portfolio, I'm getting the numbers mixed up now, less than 20% of my portfolio are what I call speculative investments. The other 80% are more of the proven investments. So 80% of my portfolio is real estate and stocks. The bulk of my real estate portfolio and my stock market portfolio are primarily for cash flow. In fact, all of my real estate investments are for cash flow, but the bulk of my stock market investments are for cash flow. That's 80%. 2% is physical gold. That leaves 18%. But in there, that 18%, these are what I call my speculative investments. This is where I invest in things like startups, and this is where I invest in things like cryptocurrency. So now, if cryptocurrency went down to zero and I lost all of my cryptocurrency investments, would it affect me? No. But I also believe in the value of the blockchain. I think there's a lot of upside, which is why I invest in it. If you are going to invest in cryptocurrency, you have to be willing to accept that risk. You have to understand the volatility of cryptocurrency, and then you have to know why it is that you're investing in it. So understand that for what it's worth. And again, this also creates another potential protectionary investment, but I'm hesitant to say that just because of how new cryptocurrency is and how volatile it is as well. But it is a way to diversify your money away from some of the traditional investments. If you want to be a high earner or a high achiever, it starts with your mindset. And what I want to do now is go over 10 mindset shifts that you can start making today that all high achievers are doing. And number one is the blue ocean mindset shift. There's a book out there that I highly recommend you read called The Blue Ocean Strategy. And what the Blue Ocean Strategy